Okay, this is Philip Parker with recording for RETL 262 chapter 15, and just wanted to let you know that we're going to cover this chapter PowerPoint online, and then I'll assign the homework at the end of this PowerPoint. So let me start by saying this is chapter 15, investments in international operations. The big thing to know with this chapter is there's different rules or accounting for different types of investments. There's different motivation for investments. Obviously, trying to produce high income for the company, and so they make these investments for various different reasons. Part of which could be because they have excess cash right now, and they want to make some income on that cash, and so they'll make investments. Short-term investments are those that can be converted to cash within a year. Okay, so they're readily convertible to cash. We call that good liquidity. Cash equivalents are not considered short-term investments for a company. Cash equivalents are things like savings accounts, checking accounts, and any short-term investments like 3-month CDs. So anything that can be converted to cash within 3 months would not be considered a short-term investment. Long-term investments are not readily convertible to cash, and so they're listed in the non-current or the long-term section of the balance sheet, and normally has its own category. When you get into debt securities versus equity securities, the big thing to remember there is debt securities obviously are, and this is slide number 5, I think, is this has more to do with a debtor-creditor relationship, and so just want to keep that in mind. Equity securities is more an investment type vehicle for the company. It reflects ownership into another company. When you get into classifications and reporting on slide number 6, just be aware there are different ways to report these things. If you have a trading security, basically which are investments in securities that you're actively buying and selling, those are recorded at fair value. In other words, what will it sell for in the market right now? If you have held to maturity securities, those are debt securities like bonds. Those will be considered held to maturity and need to be listed at amortized cost. So cost minus the amortized premium or discount. Then you have available for sale securities. They're similar to trading securities. The only difference is you're not actively trading these guys. Those would also be considered reported at fair value. Then if you have significant influence over the investee, in other words, you own 20% to 50% of that company, you would use the equity method for recording your investment. And if you have more than 50% ownership, you would have a consolidation. Okay, so dealing with trading securities, we're on slide number 7. Just be aware this is related to debt and equity securities. And I'll turn this back towards me now. And I'll let you take a look at, okay, it's back on me now. So if you look at slide number 7, it's dealing with debt and equity securities that are trading securities. Again, the big thing to remember is you're actively buying and selling these securities. So there's lots of volume in purchases and sales. These are reported at fair value. Normally fair value is what is listed on the stock exchanges. And so any gains or losses from the decrease or increase in fair value would be reported in the income statement as an unrealized gain or loss. Okay, that is only if you have not sold that security. On slide number, looks like 8, held to maturity securities. These are debt instruments like bonds. So you buy these and you intend to hold these until they mature, the maturity date. So you're going to report these as non-current investments if the maturity dates are past a year. If they're within a year, they're current assets. And then there are available for sale securities. These are debt and equity securities not classified as trading or held to maturity. So it's like the other category. And so really, you're going to sell these at some point, and so they are available for sale, but you're not actively trying to sell these things at the current time. So you're also going to report these at fair value. The difference between this and a trading security is the unrealized gain or loss will be reported in the equity section of the balance sheet as part of comprehensive income, not on the income statement. The next slide, 10, has to do with accounting for investments where you have significant influence. If you own 0 to 20%, you're considered not a significant, you don't have significant influence. So you use the cost or the market value method. You put that investment on your books at cost, and when you get dividends, you can record the dividend as dividend revenue. Okay. If you have 20 to 50% ownership, you're going to use what we call the equity method. So take a look at that in the chapter. That basically says you do have influence on management decisions, and so you will record your initial investment at cost, and then when that company reports their income for the year, you will also report earnings based on the percent ownership you have in that company. Okay, and then the last category is consolidated financial statements. If you own more than 50%, then you're going to add their numbers to your numbers and put together a consolidated financial statement. With the equity securities with significant influence, the original investment is recorded at cost, but your investment account is increased if the investee has earnings for the year. So at the time they report their net income, let's say it's $100,000 and you own 20% of their business, then you're going to record a 20% increase in your ownership. So you're going to increase that asset, that investment account, and you're going to report earnings at 20% of the $100,000. Any dividends received, you will debit cash and credit the investment. You're going to take down the investment that you have in that company. And so we've got in slide number 12, we've got an example of this. So take a look at slide number 12. Micron Company records the purchase of 3,000 shares of Star Company for $70,650 cash. You're going to debit the investment account for Star, credit cash. The next slide, slide 13, when they report $20,000 of net income, you're going to record your percentage, which is 30%. You're going to debit the asset account called investments in Star and credit your earnings on that long-term investment, which is going to go in your income statement for the same 30% or $6,000. On January the 9th, when you get a dividend, you're going to debit cash, and you're going to credit or take down the investment in Star Company. This is different than if you were using the cost method, as if it was 0 to 20% ownership. In that case, whenever they had net income, you wouldn't do any entry, and when you received a dividend, you would debit cash and credit dividend revenue. Take a look at slide 14. It talks about investments with controlling influence if you exceed 50% ownership. Slide 15, take a look at that. That's kind of a summary of the different methods. And then take a look at 16 and 17 and 18 on your own. And then at the end of the chapter 15, let's take a look at the end of chapter 15. Let me quickly go there and give you some problems to look at to kind of reinforce what we've talked about here. Okay, so the first thing you want to do is you want to look on page 615, and you want to do 15.3, 15.4, 15.5. Flip the page to 616 and do 15.8 and 15.9. And then flip over to the regular exercises, and on that let's go ahead and do 15.1 and 2 and 3, and then let's look at doing 15.6 and 15.9. Okay, and we'll get together on Thursday of this week, which should be November the 3rd, I believe, and we'll go over those. All right, thank you.